E. Assess impact of mergers, acquisitions, and divestitures. Mergers, acquisitions, and divestitures significantly influence an organization's financial structure, liquidity position, operational strategy, and long-term growth potential. Treasury professionals play an important role in evaluating the financial impact of these transactions and ensuring adequate funding and risk management throughout the process. Mergers combine organizations to improve market position, operational efficiency, or competitive advantage, while acquisitions involve purchasing another business to expand operations or capabilities. Divestitures occur when organizations sell or separate business units to improve strategic focus or generate liquidity. Treasury teams assess financing requirements, cash flow impacts, debt capacity, and integration challenges associated with these transactions. Effective analysis supports informed decision-making and protects organizational financial stability during periods of structural change. Treasury professionals evaluate the financing alternatives available to support mergers and acquisitions, including cash payments, debt issuance, equity financing, or hybrid funding structures. Financing decisions influence leverage, liquidity, earnings, and shareholder value, making capital structure analysis essential during transaction planning. Treasury teams analyze borrowing costs, market conditions, credit ratings, and covenant implications when determining optimal funding strategies. Acquisitions financed primarily with debt may increase financial risk and interest obligations, while equity financing may dilute shareholder ownership. Treasury professionals also assess the impact of financing structures on working capital, refinancing needs, and future investment flexibility. Careful funding analysis helps organizations balance growth objectives with sustainable financial management practices. Cash flow analysis is a critical component of assessing mergers, acquisitions, and divestitures because these transactions can significantly alter operating liquidity and financial performance. Treasury professionals evaluate projected synergies, cost savings, revenue growth opportunities, integration expenses, and restructuring costs to estimate future cash flow impacts. Integration activities may require substantial funding for system upgrades, workforce restructuring, facility consolidation, or operational alignment. Treasury teams also assess changes to working capital requirements, payment systems, banking structures, and liquidity management processes following organizational restructuring. In divestitures, Treasury professionals evaluate the effect of asset sales on liquidity availability, debt reduction opportunities, and ongoing operational cash flow. Accurate forecasting supports strategic planning and post-transaction financial stability. Risk assessment is essential during mergers, acquisitions, and divestitures because these transactions introduce financial, operational, regulatory, and integration risks. Treasury professionals evaluate counterparty risk, foreign exchange exposure, interest rate exposure, legal obligations, tax implications, and market uncertainties associated with transaction activities. Multinational transactions may involve currency risks, cross-border regulations, and political considerations requiring additional Treasury oversight. Treasury teams also review existing debt agreements, covenant restrictions, and pension obligations to identify potential financial constraints. Effective due diligence helps organizations detect hidden liabilities and operational weaknesses before completing transactions. Strong risk management practices support smoother integration processes and reduce the likelihood of financial disruptions or unexpected post-transaction costs. Treasury professionals also contribute to post-transaction integration and restructuring activities to ensure operational efficiency and financial alignment. Following mergers or acquisitions, Treasury teams consolidate bank accounts, integrate Treasury management systems, align payment processes, and optimize cash concentration structures. Treasury professionals coordinate with accounting, tax, legal, operations, and information technology departments to establish consistent financial controls and reporting practices across combined organizations. Divestitures may require separating banking relationships, reallocating debt obligations, and restructuring liquidity arrangements for remaining business operations. Effective Treasury integration improves visibility, operational efficiency, and control over organizational cash flows. Maintaining strong communication with lenders, investors, and financial institutions is important throughout restructuring and transition activities. From a CTP examination perspective, candidates must understand the financial, operational, and strategic implications of mergers, acquisitions, and divestitures. Exam questions frequently assess the ability to analyze financing alternatives, evaluate cash flow impacts, identify transaction risks, and recommend treasury strategies supporting organizational restructuring. Candidates should understand capital structure implications, due diligence processes, liquidity management considerations, integration challenges, and valuation-related financial effects. Knowledge of debt financing, equity issuance, foreign exchange exposure, and working capital impacts is also essential. Treasury professionals must recognize how these transactions influence organizational liquidity, leverage, and operational efficiency. Mastery of these concepts enables Treasury professionals to support successful corporate restructuring and long-term financial performance.